trying to see how to rectify it. But basically, it's similar to what we had in the last class, the problem one on the review. Okay, so let's go ahead and get started on not that. No, not that either. Let's go ahead and get started on. I'll show you a phone looking around my screen so you know that I'm not like, playing solitaire or something. All right, Chapter 6 handout. Okay. So Chapter 6 handout. There's a lot in here. This is pretty, Chapter 5 and Chapter 6 are pretty much the entire audit. I think we did this, didn't we? We did do this. I didn't take the stop out. Okay. I'm going to finish up these last two here, which this is kind of goes into our sampling stuff anyways. This is on page 9. My page numbering might not be right. Test the controls, which we already talked about. We already actually did them, but testing the, I should say, the client's controls. If the controls can be to reduce substantive testing. Now, for the AICPA, these are not required, only if you plan on using these controls to reduce the substantive testing. You're going to rely on the controls. If you're not going to rely on the controls, you don't need to do them. By the way, you'll see this abbreviated sometimes, even on like the CPA stuff, as test of controls. TOC. Okay, substantive procedures. This is our classical sampling. Factor mean per unit. Ratio estimation. And difference estimation. It could also be our monetary unit sampling. And substantive procedures are strictly for finding quantitatively material misstatements, dollar amounts. All right, so this is so these are what you actually use for finding whether they are there's a dollar amount to be misstated. Question on that? You already knew that. All right, so let's go on to the audit plan. Okay. So the audit plan, and I think I've told you guys this before, don't think like in auditing that you go on your job and they're going to expect you to know everything about auditing cash or accounts receivable or inventory or anything like that. It's all in an audit plan. It's a detailed plan about steps that you go through. And now you may have questions about how you actually go through those steps and that you work out with your supervisor. So, if they say, oh, you have to compare this, the accounts receivable reconciliation to the cash receipts or something like that, ask them how you do that. And oftentimes you'll see work papers from the previous year, especially if this is a subsequent audit, that you can look at. Say, okay, well, let's see what they did last year. Oh, I get it. Okay, they compared this to that, whatever. So don't think like, gee, I got to know everything in the audit plan, just build it from scratch every time. You don't. And even when you move up in auditing, you don't just recreate a plan. You may do some adjustings to it. And when you go into a new place, you'll probably say, okay, this one's kind of similar to this other audit that we had, so we'll go through this and adapt it, change a few things, and go through it. And it's always a process. I've never been on an audit that didn't change as we went through the audit. It always has. There's things that you think are going to be a problem that are not, or they don't even exist anymore sometimes. And there's things that your attention is drawn to things that there might be a problem. You have a new way of doing something, or a new product, or a new whatever. So the audit plan is never static. It's very detailed. And also, as an auditor, if you follow it, that's how usually you find stuff. By sticking with the audit plan, following it, making sure that you did it correctly. That's how you find things, not because you're some auditing genius or something. Okay, now I think we've talked about this. Relevant assertions. Something's called management assertions. They are explicit and implicit in the financial statements, and I'll talk about why that is, what we're talking about. Okay, when you do an audit, the client will give you the financial statements. Right. Here's our financial statements. We want you to do the audit on it and give an audit report to go along with our financial statements that we're handing you. They have to come up with the financial statements. It isn't, gee, could you make our financial statements for us? You can't, because then you're not biased. Then you are biased, I should say. So they have to hand you the financial statements, and that is what you are going to test for, those financial statements. Now, when they give you the financial statements, there's some things that in there that they may have explicitly in the footnotes, claim that they've done, but there's other things that are implicit. If they hand you financial statements, it's implicit that everything is there. That they're, we didn't put in the expenses for rent. None of that kind of stuff. When they give you the financial statements, that they are complete, that they have everything there, that things that they say they have, they do have. That if they say a transaction occurred, that's it's implicit in the financial statements, for instance, for sales, a sales transaction, that these sales transactions actually occurred. It isn't like, oh, well, yeah, we thought we were going to get more sales, but that's what, none of that. It's, these are assertions that come with the financial statements. Sometimes they're explicit, sometimes they're, put in the footnotes that they're saying exactly what they did. But also that just in general, they're saying that these financial statements, everything's there, and there's nothing extra there either. So these are kind of the things that we test for, and so these management assertions are, when we make tests, we virtually always make it towards one of those assertions. I'm trying to think if there's for testing, it pretty much all is towards those assertions that we have everything. So let's take a look at some of what these assertions are. Okay, now we have two sets of assertions. They used to be the same, now they weren't. The PCAOB assertions are what the AICPA assertions used to be, and those are still the same. The AICPA has altered their assertions a little bit. And I think I'm going to start with the PCAOB assertions, and then I'll talk about these other ones up here. Okay, the biggest ones here, so big that I have punctuations I don't need. The biggest ones here are the existence and occurrence, or occurrence. Does it exist? Did it occur? And the second one is going to be these. We do a lot of testing for existence and existence and or occurrence and completeness. These two are probably the two biggest ones that we do. For inventory, does it exist? If we have inventory and we sold it, did the sale actually occur? Do we actually sell the inventory? Completeness, do we have all the inventory? A tremendous amount of testing goes on here, and we'll talk more about it later. But this existence and occurrence and completeness, these are probably two of the larger ones. Not that these other ones aren't. Valuation and allocation, how they value something. How do you put a value on a sale or on a piece of equipment or a copyright or whatever it is? Rights and obligation. This one can be a little bit tricky. For instance, if you go into a factory floor and you see a big piece of equipment, okay, it exists, right? So you can check off that it exists. Does that mean that the place actually owns it? You walk in the place, you see the big piece of equipment, whatever it is, on the books at but so you can go put your hands on it. You can tell it exists. It's not like they just made it up. But is that proof that they actually own the piece of equipment? What do you think? Nope. Yeah. It's not. They may be leasing it. Or it may even have already been sold and it's just sitting there waiting for someone to come pick it up. So just because it's there, it exists. You can go say, okay, yeah, check off the box that it exists. Does not necessarily mean that you own it. And so you start looking to see if there's other things that maybe it's pledged as collateral for a loan. Maybe it's being leased from somebody else. So these are all things that we need to check on when we go through and do our audit. Is these all kind of work together. Presentation and disclosure. How do they show things? How do they disclose things? How do they put in the financial statements? For instance, it's required that however you do your inventory, FIFO, LIFO, average cost, or whatever it is, it's required that you put that in the footnotes, so that someone reading the footnotes will know how you're taking how you're doing your inventory, And so that will give them information as to how they can, because they may have one company that they're comparing it to that does it by using LIFO, and there could be another company that's using FIFO. They can get different numbers even though they have exactly the same sales or whatever. So so those are all things that we got to kind of pay attention to, is how they're actually putting those things in the footnotes. Depreciation is another one. Depreciation of equipment. How do you depreciate it? Do you straight line or accelerate it, or how, many companies have conventions of depreciation. What I mean by that is, if you buy equipment throughout the year, you buy something in January, February, March, blah, 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 you get the idea. Like let's say UPS, they buy trucks throughout the year. Right? What oftentimes they'll do is they'll say, okay, look, we bought all these trucks in 2023. Some we bought in January, some we bought in March, some we bought blah, blah, throughout the whole year. What we do is take all of those trucks, count those as 2023 purchases, and say, okay, on average, we had them for half a year. Some trucks we had for 12 months, some trucks we had for 6 months, some trucks we had for basically 0 months if they bought them at the end of December. So I say on average, for these 2023 trucks we bought them, halfway through the year. So we'll do 6 months of depreciation for every truck that we bought in 2023. Why? Because there's probably thousands of them. And to sit there through each truck and say, okay, this one was bought on January 13th. This one was bought on January 16th. This one was bought, it was too much of a hassle. It's not worth it. It's not going to make financial statements any better. So a lot of times they'll have what they call like a half-year convention. Okay, bought the trucks, they're going to last for however many years. But the first year, we're going to take 6 months of depreciation whenever we bought them. Excuse me. Okay. So these are the PCAOB assertions, and these are the ones that I would say probably are the big ones we have. Now, there are some ones up here that are a little bit different, and I'll talk about those and kind of how they came about. Basically, everything that is up here is somewhere down in here. It's just kind of broken out a little bit more through the AICPA. For instance, cutoff. Cutoff is basically a cutoff of, like, say, sales. Could be purchase cutoffs at year end. Okay, these can kind of be spread out over these down here. It could be existence or occurrence. Do we actually make the sale? If they count a sale on January 1st as being for the previous year, did it occur in that year? Well, no. So it could go down to an occurrence. If it was an asset, what asset that goes along with it, whatever, does it exist? For instance, if you make a sale there, for a product, well, that's going to reduce your inventory also. So the occurrence and the existence kind of go together for that. Because if the sale did occur, then the inventory shouldn't exist. Right. So a lot of these that I have up here that are different, they usually do fit in. So for instance, classification. This is sort of the same as presentation and disclosure. So it isn't that they're testing completely different things here. They're just kind of breaking out a little bit more complete. Authorization, the authorizations of it. This would be more along the lines of, say, rights and obligations, but also usually some kind of a almost more of a control over what they're actually doing with it, of how they actually bring things in. But the authorization is that generally all the transactions are made with the authorization of management, and it kind of goes into all of those. The one that's the wackiest of all of these up here is this one, accuracy. And accuracy is really the one that stands out because it's not going to be shown down here. Accuracy only applies to individual transactions. I'm going to make this one a different color because it is different than what's down below. And I'll talk about why it's such a wacky one. Okay, accuracy is wacky because we never say the financial statements are accurate. Never, ever, never, ever, never. We never say they're accurate because we don't test down to the penny. We probably don't know that they're accurate, and B, to test to that level would be ridiculous. So we never say the financial statements are accurate. We say that, in our opinion is that they are free of material misstatement. They're fairly presented. We give reasonable assurance. We don't say that they're 100%. We never say that. So say, okay, well, what is this accuracy thing doing here? Accuracy means that for each transaction we look at, there is the assumption that it is accurate. So if you are looking at an individual transaction, there's the assumption is that it's accurate. It's not misleading. It's not the transaction itself. Now, if there are misstatements in the financial statements, that there must be some problem there with the accuracy of whatever they're doing. But it is only for each individual transaction that you're looking for at that it's assumed that they are accurate. So whenever you take on a transaction, look at a transaction, that it's the assumption is there that each transaction is accurate. Not that the financial statements overall are accurate, only that thing that you're looking at, there's the assumption that it's accurate, that they're giving you an honest transaction, basically. So accuracy is a kind of strange one, that kind of outlier there, because we don't actually report on it, but each transaction they do. Okay, so let's take a look at what we look at for substantive test plan for assets. Okay. So establish the existence of the asset. So this is sometimes called book to floor. Did we talk about this already? Oops. Did we talk about book to floor, floor to book?
Yeah, we talked about book to floor.
Okay. So book to floor, see if does it exist. You look at it on the books, you say, okay, here's the assets on the books. You get a listing of assets to go find, and you go find them. And, sometimes it's easy, sometimes it's not. I think I did tell you about it. I told you about that engine that I couldn't find, I think. We had a really expensive engine on the books that it was listed in inventory that I couldn't find anywhere. And that I actually did find it. It was done it was in testing, and it was one of these engines that they make to extreme specifications. If everything's perfect on the engine, this is how it would run, and they run it for days or whatever. Then they compare it to, occasionally pull engines off the assembly line and run those and compare it to this kind of test engine. But anyway, this engine was like really expensive, but no one knew where it was. Well, it's because it was in quality control people had it. So anyway, so that's book to floor. You find it on the books, you go find it on the floor. Completeness is sort of the other way. You find something on the floor, and you go find it in the book. So you walk around the plant, look for things that you look for things that are out of place or something, or things that aren't being used, and then you check to see if it's on the book still. So these are two of probably the biggest ones for when you're looking at an asset account, especially for a physical asset. You know, book to floor, find on the books, go look at it, and floor to book. So these are the ones that we, and your plan will have something along those lines. You pick a sample from the book, go to the floor. You pick a sample from the floor, go to the book. Okay, establish that the company has the rights to the asset. Look to see if there's if the assets are pledged as collateral. You might look at loan agreements from the standard bank confirmation will have loan agreements on there. They'll say whether they have pledged this asset. Sometimes when they make a big purchase of assets that they will, whether it's inventory or machines or whatever, the bank will give them the money, and then the bank says, okay, but we're using that as collateral too. You know, you bought this big expensive machine, and that big expensive machine will be ours if you don't, pay the bill. So you also look at the rights and obligations on it, and you're looking at that more to see that they put them in the footnotes that, yeah, this machine is used as collateral for this note payable or what loan or whatever it is. So that's one of the, those things that you kind of always pay attention to. Also, you might look for things like rent or lease expense, because if you see rent or lease expense, it may be that they have this asset on the floor, but they really don't own it. They're paying rent or leasing this thing from somebody else. So that would be testing for the rights and obligations. You look at the lease or rent payments. Okay. Verify the cutoff of transactions, especially for inventory. Oops. So the cutoff of transactions, notice that, and this is why inventory is such a big deal. What's the big deal about inventory? The big deal about inventory is that it's tied to sales. So, for instance, when we look at the cutoff to make sure that it's in the right period, if they are selling something outside of the period, that item might be on the floor. You may have actually inventoried it, and they're counting it as being sold. So notice that they're kind of like double dipping there. They have the asset, it's on the floor. They didn't sell it till January 2nd. On December 31st, it was on the floor. You counted it. You saw it, went out and touched it. You verified that it was there, whatever. So that tends to be a problem, because now they're not only are they overstating sales, they're also overstating assets at year end. This can kind of balloon up, being more than just the normal, even a normal sale, because that inventory, if it's on the books, will be taken off of the cost of goods sold, and you run into a problem. So inventory is one of those things that, because it affects sales, accounts receivable, inventory, maybe even cash, depending on how the sales is made. The cutoff is really important for those. Okay, let's take something that's not so important. Cutoff for, say, property, plant, and equipment. First of all, property like land, if you buy land, you don't depreciate it anyways. The cutoff it's not going to change the income statement. If we bought the land on December 26th or on January 1st, the income statement isn't going to have any impact on it. And truthfully, even if it's a piece of equipment, okay, let's say we bought it on the 26th of December, didn't put it on the books until January 2nd or 3rd or whatever it was. That's usually not that big of a deal for the income statement. The income statement in US accounting, the income statement is like the big deal, but there's not going to be any depreciation on it anyways. You round off depreciation to the nearest month. If you bought it on the 26th of December, you don't depreciate it in December. So there's not going to be any impact on the income statement, even if it's a big piece of equipment. Now, do we want to have it on the books if we purchase it? Yeah. It's not as critical, but yeah, you want it on the books because there might be not only this asset that should be on the books, but there maybe even be a liability with it, that goes on the books. But yeah, so well, for bigger things that are not inventory, it's not as crucial for the income statement as it is for, say, inventory. So inventory is the one that we really generally, when it comes to the assets, what we really look at, and especially this cutoff thing. Okay, determine the appropriate valuation of assets. Are they impaired? Is there a problem with them? Obsolete, that sort of thing, especially for inventory that's been sitting around for a while. And are they showing presentation and disclosure, for instance, LIFO, FIFO? And for equipment, maybe you'd have a depreciation. These are all things that you how you put them in the financial statements, but also how you disclose those in the notes are very important. And one of the things that is often missed, and I think even by a lot of people who do auditing, is that the footnotes are generally not, well, the footnotes are required for GAAP. So even though we have this, presentation and disclosure thing, which is obviously there for a reason, most of the time, those footnotes are required by GAAP. So if they don't have the footnotes, they're not following GAAP, because GAAP says you must put those in the footnotes to the financial statements, especially things like inventory, depreciation, that kind of thing. If there's any kind of a different method you're using for sales recognition and all that, those all are required to be in the footnotes for GAAP. They're not optional. So if they are not putting them in the footnotes, the financial statements are not GAAP. Okay. What do I have here? Oh, not too much. Okay, good. All right. This is something that's kind of come about recently. Now, it's been around for years, but auditing to transaction cycles or classes of transactions. This is let me put this. Okay. So a lot of the audit steps we have are testing two accounts. So now, for instance, we test the cash account. Then we go and we test the accounts receivable. We go test the inventory. We test the property, plant, and equipment, and we kind of go around the balance sheet basically, and we test the accounts. That's usually, for the most part, that's what probably a vast majority of CPA firms do. However, there is this requirement now that they also must look at the cycles. In terms of cycles, that they may have more than one account associated with it. For instance, sales. You make a sale, it goes through the through accounts receivable. Accounts receivable goes through collections, goes into cash. So going through the cycles instead of saying looking at cash and associating with all these other accounts, they look at complete cycles, and there's 6 of them. And there's always been CPA firms that have done this, but now it is in the kind of on the books that this is one thing that they should be looking at. The actual testing is exactly the same, and for some of these it's a little bit redundant. Like for instance, cash. We talked about how cash goes through everything, so you get this idea that cash is going to be reappearing, all over the place, even though technically it's something, a different cycle of what they have. So while it does look like it's opposed accounts, the account testing is exactly the same. So like sales and collections, this goes into cash, collecting the cash. Acquisition cycle, disbursements, that's cash. Conversion is making a payroll cycle, paying off in cash, investing cycle, finance cycle. These are all, they all have individual accounts associated with them. The account testing themselves has not changed. It's just how they group those. That you might group more than one together, sales and cash receipts. That you would group those together rather than this. You audit cash, you go through everything. Down here, it's kind of broken up. The cash is kind of spread out, but the testing of it will be exactly the same. Man, this is a long handout. Okay, so anyway, there are these transaction cycles. The actual testing is not any different than it was before. There's no new test for the transaction cycles. I think their idea behind it is that you see the complete picture of how things flow through the company, and it does happen this way. I'm not saying it doesn't, but the actual test of the individual accounts is going to be exactly the same as before. But putting them together in an overall picture, I think that they think that there's value to that, and there very well could be. CPA firms have been doing that. Different ones have been doing it for years, so it's not that unusual. It's not a new concept, I'll put it that way, even though it's a new requirement. Okay, documentation, work papers. Okay, so who owns the audit documentation? Did we ever talk about this? I can't remember. So these are the work papers, and you go into a company and you do the complete audit, and the question is, who owns the audit documentation? Can the client ask for, you making all these work papers, and the client says, hey, when you're done with the audit, I want the work papers. We're paying you all this money, I want the work papers, or I want a copy of the work papers. The work papers are the property of the audit firm. The audit firm retains those work papers as evidence should they be brought into court that they, did their due diligence, that they actually did the things that they were supposed to do on the audit. It's their evidence to back up their audit opinion. It's owned by the auditors, not the client, and the client has no right to those work papers. Now, if you did find some actual errors, let's say you're testing for some accounts and you find some accounts that were off, the client may very well say, well, can you tell us what accounts were actually messed up so that we can go correct them? There's nothing wrong with them asking for that, and you would probably be happy that they would go correct them. But you're under no obligation to share those work papers. Another thing about those work papers is sometimes there's things in there that are not meant to be shared with the client. maybe there's someone in the company that had a tax evasion problem or something like that, that while it didn't affect the audit, and you looked into it and nothing came of it, you don't want that spread around the company. Oh, did you know that Joan had, was charged with tax evasion and, whatever, that's has nothing to do with the audit. So there are some things in there that, even though they may have come up, however you say it, they may have arisen during the audit that you don't want to share. For ethical reasons, you don't want to share some of the information, and maybe there was nothing of it. Maybe someone, you get this indication that she had, someone had done tax evasion, and they really didn't. Well, you certainly don't want to spread misinformation out there either. Okay, so who owns it? The auditors. And they're evidence of, let me put this in here. That they're evidence, they're your evidence that you have, that you planned, performed, and supervised the audit up to the professional standards. Okay, they are used, the work papers are used to support the audit report and the opinion. Maybe it's also in there, they so evidence to support the audit report, whatever opinion you came up with, like, if you're dragged into court, you say, okay, well, here's how we came up with this opinion, here's the evidence to support it. I gotta check something here. All right. Working paper review. I wanted to see if I had this down below. Okay, there's actually there's two different requirements for it. Requires an audit review. And the PCAOB requires an audit review, PCAOB. And by review, we mean somebody else who's not in the audit coming through and taking a look at the financial statements. There is a difference, though. The ACCPA allows it, it can be done after the audit report is issued. The PCAOB requires it before the audit report is issued. So there is a slight difference here between them. The ACCPA, it can be done after the audit report is issued. PCAOB says, no, you have to have it reviewed before the audit report is issued. So if it's a publicly traded company, and this probably has more to do with the magnitude of it. So if it's a publicly traded company, they say, no, you have to have somebody look at this, review it before you issue this report out to potentially millions of people who are relying on these financial statements and your audit report that goes along with it. So the ACCPA they're required to do a review of the finance of audits. It can be done after. PCAOB says you must have a review done, and they have actually specified different people that, it has to be somebody unbiased about the audit, who knows what they're doing, as an expert, obviously, but is unbiased to look at the review, or excuse me, to review the work papers, and that has to be done before it's issued. So there's a time crunch to have this, and having these experts kind of lined up to review the documentation to see if it adequately supports their opinion. PCOB before the audit report is issued. So while it's it's required, it's there is a slight difference there. And again, it has to do with the magnitude, I think. PCOB is companies with billions of dollars, millions of investors, whereas smaller audits don't have that. Okay. We have permanent file stuff that we would take to every year, the audit, and we have current file stuff. This is only stuff that's used in the current year. You can go through these. Some they're not too I don't know. They're not that straight. So some of these things you just update every year. For instance, the chart of accounts. What accounts do they actually use? The organization chart, you'll update that. Okay, who's okay, she's the new president, and then who's the new chief financial officer, and all that kind of stuff. Copies of contracts and that sort of thing. Documentation, internal control will go from one year to the next. This is all just kind of stuff that won't change too much from one year to the next. The current file is only stuff for the current year. The audit plan for this year. That's going to be a copy of the financial statements that they gave you for this year. Minutes of important minutes are just the notes, and so on and so forth. So I don't know, it's that big of a deal, but there's a permanent file that goes from year to year, and it's usually for big stuff that doesn't change too much. And current file is the stuff that's for the current year. Okay, let's review. Review problem 1. During the audit of a client, a member of the audit team discovers an understatement of $50,000 in an expense account. Okay, so here's the client's information. The overall materiality is 70,000. So, is the $50,000 understatement a quantitative material misstatement? Quantitative means just the dollar amounts. Is it quantitatively misstated? So just looking at the dollar amounts, we decided the overall materiality was 70,000. We find this understatement of 50,000. Is that material quantitatively? In other words, just by the numbers. Oh, come on. Take a guess. Be wrong once. You put it in chat. Put it in chat. You put it in chat. You can private me in chat. Well, come on. No one has a coin.
It's not
Yep,
a quantitative because it's below 70,000.
exactly. It is not a material misstatement. Oops. No, the $50,000 is not a quantitative. So this is actually an immaterial misstatement quantitatively. Clean this up a little bit. Okay, now qualitatively, is it a material misstatement? Now let's take a look and see what these financial statements should have looked like if they had the $50,000. The expense account was correct. Okay, so if 2.8 million. Now notice that these expenses should have the other 50,000 into it, right? So I'll say plus 50,000. I'm not sure. Maybe I should put it in minus 50,000 because these are minuses in total. However you want to think about it, I guess. Okay, so this should actually be minus 2830, 2,830,000. So the net income would actually be a loss. Let's put dollar signs in front of those, just for kicks. Now, notice what's happened here. You know, this $50,000 misstatement is not a quantitatively, it's not a material. But is it qualitatively material? And to answer that, we go back up to here. All the way up here, qualitative considerations. If it violates the term of a contract, reverses a trend, changes a loss to a gain or a gain to a loss. Management compensation, whatever. So anyway, it does. This is a reversing of a trend or whatever. It could be that it's not income anymore. They maybe had income every year, but certainly this one, changing a loss to a gain or vice versa. In this case, changing a gain to a loss would be also there. So this is more than likely a qualitative misstatement because it reverses what would be, a loss. It should have been a loss. It reverses it to be a gain. There's a difference in the minds of investors between a company that's profitable and one that's losing money. Even if it's not very much, there is the idea that a profitable company is different than a non-profitable company. So this would probably be yes. So if it reverses a loss into a gain, in this case into income, then it very well could be qualitative. And this is one of the kind of classic examples of, that the idea is that a company that's profitable is different than a company that's not profitable. Okay, so qualitatively, this is most likely going to be considered a misstatement. Because it changes a company that's losing money to a company that's making money. Even though it's not very much, maybe it still has a different connotation. But it could be that it violates a contract. That's another thing we have to pay attention to. For it to be a qualitative. If it reverses a contract, if it reverses a trend, it reverses, there's other things that are involved there, which is one of the reasons why, generally speaking, the AICPA does not require you to make the judgment of something being materially, what's a material misstatement. They may have you do calculations to see, what you would consider based on your rule of thumb, if you take 3% of sales or whatever it is. But as far as actually you coming up with your own judgment of it, they generally don't do that. And now a lot of times when they do have something about materiality, they'll say that it is materially misstated or it's not materially misstated. And you just go with that because they generally don't make you get into the judgment call of whether that's a material misstatement or not. Okay, is there one more here? There is one more here. Okay. I thought it was ahead of time. I'm not ahead of time. Okay, testing for assertions. So this is kind of going back to this stuff, testing for these. How do you do it? How do you actually do it? Well, this is kind of the flow of information generally that you get in a company. You'll have source documents, receiving reports, shipping documents, all this kind of stuff. Those will lead to journal entries. They could also be special journals, like a sales journal or something like that. The sales journals are just that if you have a bunch of transactions that are similar, you'll have a journal for them. For instance, sales on account are, it's accounts receivables, the debit, sales are the credit. They're all like that. Now, if you make 50 sales a day, do you want to make 50 journal entries? No, you have a sales journal that lists all the sales, and at the end, you put in the one journal entry for the sales for the day. That's a sales journal. General ledger, this gets the account balances. Trial balance just comes out of the general ledger. It has only the ending balances. And then finally, we make the financial statements off the trial balance. So this is kind of the flow of documents. Okay, now we're going to beat this up for completeness or existence. So completeness means that everything is included in the financial statements. Existence means that there's something in the financial statements to proving that it exists. Okay, so tracing source documents to the trial balance would most likely be associated with which assertion below. So here's the source documents. Oops. And we're going to take these source documents and see if they go through the journal entries, the general ledger, and then take them right through to the trial balance. Is this for completeness or existence?
Existence?
Actually, this one's going to be for completeness, that everything that we got in, receiving reports, for instance, that those will show up in the trial balance. So this is going to be a completeness test. Where is it? To see is the trial balance complete? Okay, so going from the source documents forward, is it complete? Okay, tracing journal entries to the source documents. So you take these journal entries here. And you trace them backwards to the source documents. What would you probably be testing there? Completeness or existence? You want to make sure that these journal entries are valid, right? So if they make a journal entry for whatever it is, a sale, a purchase, whatever it is, you want to make sure that that actually is. They just didn't make up this journal entry. So this is trying to see if it actually exists. So when you're going backwards, you're kind of looking at to see if it exists. Okay, so going forward, you're seeing that everything is included. Going backwards, if you have something up here, do you have support for it back here? Does it exactly exist? Okay, tracing the shipping documents to the financial statements. So here's the source documents. We're going to trace them all the way to the financial statements. We're going to go forward. So we're going from source. Let's make sure I got that right. Which the following most likely be, oh, wait, this is a different. For existence. So we want to make sure that these exist. So which way would we go? Would we be shipping documents to the financial statements or financial statements to the shipping documents if we're testing for existence? So we find something in the financial statements, it's there, and we want to make sure that it exists. So are we going to go from the source documents to the financial statements or financial statements to the source documents? Whatever they have. Does this sale exist or does this inventory exist or whatever? Anyone?
Would they go from the financial statements to the shipping documents?
Yes. They won't spell it this way because that's misspelled, but yes. Yeah. So you look at the financial statements, you go, okay, they have a piece of equipment here. Well, let's go back and see if they actually bought this equipment. There should be documents, invoices, receipt reports, whatever for it. So you're going to trace from the financial statements back. So existence kind of goes from the financial statements back. And completeness goes forward. Which of the following tests would be associated with completeness? Tracing the sales journal to the source documents. Oh, this is a different way. Hold on. Or tracing the sales journal to the trial balance. Man, what wacko wrote this thing? All right. So if you're in the sales journal and you're testing for completeness, would you be going back to the source documents or forward to the trial balance?
Forward.
Yep, good. You'll be tracing from the sales to the trial balance to make sure that that sales journal is included in that trial balance. And so, this existence completeness thing, this is a big part of it. Let's go ahead and save that. Okay. Did everyone get this control worksheet? You cannot. Wait, you can't see it. Did you guys get this? I sent it out later in the email.
Yes.
Okay. So let's work on this when we get back. So let's take a break. Let's say be back at 7:19. That's not a 7. There's a 7. Okay. Okay, I want to go over the test controls thing. I've never felt like I taught that very well. I'm going to alter the handout in the future, but I want to kind of go over, this whole idea about the test of controls and, what do we do with them, these test of controls. And so let's go to the first one. There's an allowable, tolerable error rate. So this is what the auditors will accept. And we do our test, and we find the actual error rate. But we also have this allowance for sampling risk. And this is the same thing that we do for the substantive test. Remember on the monetary unit sampling, hey, we're going to do that later on. But the monetary unit sampling where we say, okay, this is what we think it is, but it could be worse. Yeah, our best estimate is this is what it is, but it's a sample, so at 5%, it could be this much worse. We do the same thing. It's exactly the same thing, except now we don't do it in dollars. We do it in usually error rates or percentages. Okay, so if we add these two together, this will be our upper limit on the what do you say? On the error rate. Okay, so we do our test. It comes up that the error rate is 3%, but it could be off by another 4%. So the upper limit on this thing is 7%. So we have an allowable rate that we'll be happy with if it's 8%. We find the upper limit is 7. So can the client's controls be relied upon?
Yes.
Yep. Yes. So we can rely on the client's controls. Our testing shows that it's still less than the allowable tolerable rate, how they present it. All right, let's do number 2. I'm going to bold all of these. Oops. So second one, we have an allowable tolerable rate of 5%. We'll allow it for up to 5%. We have sampling risk of 4%. So what's the upper limit on the error rate?
4%.
Yep. So our best estimate is that it's not off at all. So best estimate is off 0, but it could be off by up to 4%. In this case, that's the only thing that's in the upper limit. So do we rely on these controls?
Yes.
Yep. Okay. How about this one? Can we rely on the controls?
No.
No, it's higher. Number 4, be careful. Some jerk goofed up the order. Let's not go into who that jerk is, but someone messed up the order of these. So can we rely on the substantive testing?
Yes.
Uh,
Oh, you messed up the order. I get what you're saying.
yes.
No, you can't.
No, you can rely on it. You right the first time.
Okay.
Yeah, the allowable. So this is the allowable rate. So this is kind of like this up here, and down here, we do those in a reddish hue. So the upper limit would be 8%. No one. Teacher saying stupid things. Okay, so this is the upper limit is 5. The tolerable rate is 6. We're fine. This is okay. Can they be relied upon? Yes. Yeah. So be careful that they, whatever way they put it. So the allowable is really what we're looking at. If we can rely, this is what we will be happy with, basically, the allowable, sometimes called tolerable rate. And as long as it's less than the upper limit, or more than the upper limit, I should say, the upper limit is less than the tolerable rate, then we're fine. So this comes from our testing. And again, it's the same thing as we did for it's got that bell curve kind of thing. So, okay, this is what we think it is, but it's a test, it's a sample, so it could be up by a little bit more. And that's the allowance for sampling risk. Okay, coming down here a little bit different. All right, so let's go through and see if we can rely on these first. This is same. This is similar to the one we just did above there. This is the allowable. And so we add these two up. Okay. Okay, so that's what, 6%? Okay, so can we rely on the controls?
Yes.
Yes. Okay, so we're going to do some substantive testing. We're going to do a ratio estimation. So this is in our plan. And the sample size is 220 items. Will the auditor need to increase the items in the substantive testing? No.
No.
Yeah, no. It's no, we can rely on the controls. So we're going to keep our testing the same. And notice, if the planned substantive test is 220, that was based on these tested controls. And you see why? Well, the plan must have had the tested controls built into it, right? So that, okay, if we can rely on the controls, then we'll do 220 items. Now, it could be that they didn't plan on using the internal controls. In that case, we wouldn't have anything to talk about right now. Because you could just do a pure substantive testing. But if they did the test of controls, they must have been trying to rely on them. There's no reason to go through all that expense of doing test of controls if you are not going to rely on them. So they did a test of controls. They found out they can rely on them. So they will stick with the plan and take the 220 for the substantive testing. And hopefully that goes without a hitch. And yeah, so they don't need to. Okay, so let's go to the next one. Okay, yeah. All right. Okay, remember that jerk I told you about earlier? Well, he switched it around again. So here's the allowable or tolerable, and here are the allowance for sampling risk and the actual. Hey, look, it's the same. Okay, so can the controls be relied upon?
No.
Oh, oops. Okay, so in this one, we cannot rely on, they cannot be, look at those big letters I wrote, big angry letters. This is because you're an auditor and you realize that you just wasted a bunch of time doing boring test controls and you can't use them. All right, so after you stop crying, you get yourself together. Now, will the auditor need to increase the items in the substantive testing?
Yes.
Yep. Good. Yeah, you can't rely on the controls. You did the test of controls. The only reason why you did them was hopefully that you could rely on them. And find out you can't. So you cannot reduce the substantive testing. If you could rely on the controls, you could reduce it, but you can't rely on it. So now you have to increase it. What do you increase it to? It could be anything above. It could be 180. Whatever. That's we're not going to get into what you need to increase it to, but something more than the current amount. Hey, what happened there? Okay, back here. All right, let's take this one. So the allowable is that. Okay, so can we rely on the internal controls?
Yes.
Yep. And you say, well, okay, why'd you put that one in there? I put this one in here because it is possible if the error rate is substantially less than what you think it's going to be, or the tolerable amount, will they need to increase? No. And in fact, they may even be so comfortable with the controls that they may even reduce it. So if this upper limit on the air rate, if it's low enough, it could be like, oh gee, we thought that was going to be, around 6% and it's only 4. It is possible that they could even reduce the sizes. So, you know, the testing controls are there to reduce the substantive testing, is to save money. That's the only reason why they do it. Basically, for issuers, they have to do it because they do a report on internal controls. But if they're not an issuer, if they're a regular company that needs a audit for the banking or investors or whatever, there's no reason to do tested controls unless it reduces the cost of the audit. And you want to be able to rely on them so that you can reduce the cost of the audit. And it is possible if the controls, you think the controls are maybe from previous years, they weren't as good, they really tightened them up. You may say, well, we don't even need 78, maybe we need 50, whatever it is to get comfortable. And again, these are judgment calls, but yeah. Okay, let me save that. I'll put a drop for that in Blackboard. Okay, let's go to, no. Save that. Okay, and we want to go to practice exam. Testing controls. Hey, we just did that. Classical sampling. We did that last week. Okay. Monetary unit sampling. What are the things you're gonna have to do on the oops. I don't know. One of the things you got to do on it is find the sample size. So here's our formula for sample size. So we will do this. This one, usually people rarely miss this one. Maybe math error or something. Okay, and you just kind of plug in the numbers. So 500,000. Expected misstatement is, total misstatement is 30,000. Expected misstatement is 1,200. And now it gets into the wacky stuff. This doesn't look right. No, the formula is correct. I thought I had another space here. Okay, so what we need to get these two things. We need to get the reliability factor, and we need to get the expansion factor. So these are the two things we need to get onto our table to get. Okay, reliability factor. We go to 0 misstatements. Why? Because it's sample size. Oops, sample size. This is at 10%. So 2.31. Make this green. Okay, down here, the expansion factor, 10%. Luckily, there's only one row for these, so we don't even have to worry about which row to use. So this is 1.5. And I thought that I left a space for the calculate the sample size, but apparently I didn't. I'll look at the Let's look at the exam and see if I did it different. Okay, so basically we're gonna look at this. So I'm gonna oh, okay. Oh, let's put it up here like this. So 2.31 times 50,000. I finished the calculator. $115,500.
Is this supposed to be 50,000 or 500,000?
Oh, yes. It's supposed to be 500,000. My bad. Thank you. Okay, and the on the bottom we have 30,000. Minus 1,200 times 1.5 is what? 1,800? Yes, 1,800. Okay. And so this equals, oops. I do that right. Okay, so there's this divided by 30,000 minus 1,800 is what, 28,200? And so this will be our sample size. And we round it off to the nearest so 40.95, 41. You guys got it? Okay. Now we have to get the sampling interval. That's just 500,000 divided by 41. I'm not sure why I did the way I did it here, but hey, okay, so 500,000. I'm gonna round off to the nearest dollar. And feel free to do that. 12,195. Is that what you guys got?
Yes.
Yay. Okay. So that's fine. This again, this and that one, almost nobody misses that. If they do miss that one, it's because of math error. Well, like some knucklehead puts in 50,000 instead of 500,000, you know, that kind of thing. Okay. All right. This in here is the most missed part on the test. And for good reason, it's wacky. Okay, so let's go to these, let's go to the projected misstatement. All right. Two of these are wacky, one of them's normal. What's unusual about the first one? Okay, I'll tell you. It's an overstatement. It's not supposed to catch these. No, it's supposed to catch when people make the book value really large and have a misstatement because of that we catch it. So this is actually an overstatement. The audit amount is larger than the book value. Misstatement is 0. There is no misstatement. And again, this is not included in the incremental allowance. There's nothing to include. It's fine. It's one of those things that as an auditor, it kind of rubs you the wrong way. You find a misstatement and you don't do anything with it. You say it's fine. But anyway, that is it. Okay, this one, we can go ahead and do our regular thing. We take the audit value divided by kind of like a ratio analysis. So 40 divided by 200, 40 divided by 5,000, sorry. No, 40 divided by 200 times 5,000. Okay, so the projected value is 1,000. And so the projected misstatement would be how much?
4,000?
And this is a normal run-of-the-mill one. This is what kind of you expect to have. So this would actually be included in the incremental allowance. And the reason being is there could be more things wrong with this interval. You know, we only took 200 of these 500 data points, basically. We took 200 of the 500 data points. There could be more stuff wrong in there. So it matters how big this error is because it might be worse. Okay, there's something wacky on this one. What is it?
The book value exceeds the interval?
Yep. So this is the wacky thing on this one. This is the book value is larger than the interval. So this is wacky because, well, first of all, there's a 100% chance this is going to get picked. This is exactly why we do this method, by the way. Is when they increase it, if they increase it, you know, if they left it at 4,500, it may not have been picked. But the second they go larger than the interval, it's a 100% chance that it'll get picked, 100% chance that it'll be found out. And this is why we do this method. Okay, so, and this may cover one interval, it might cover two, possibly. But at this point, notice that it's everything in this $5,000 interval is covered. Every data point is covered. There's 5,000 data points in here. Every one of those data points is covered. Okay, now, so what we're going to do is do the actual misstatement. The actual misstatement is 5,700 minus, oops. Is that 1,200? So the actual overstatement here is 1,200. Now, this is not included in the incremental allowance because this could not get any worse. Every data point in this 5,000 interval is taken care of. It's been sampled, basically. It's 100% sample on this one. So could it be any worse? No. Okay, putting the extra comma in there could be worse, but so it's not going to be any additional. So this one, notice that there could be more things in there that are a problem. This one, there can't be anything else in there. We've taken, not only have we taken all of them in the 5,000 interval, we've taken 700 extra ones. So there, we just go to the actual misstatement in this case, the actual overstatement, 1,200. Does not go in the incremental allowance. So we'll talk about that later. Okay, so this is the projected misstatement is 5,200. Oops. Just adding all these up. And again, technically this, this I said this wrong. Change this. This is an understatement. I apologize. It's much harder to unlearn something than to learn it right the first time. This is an understatement, and it's not supposed to find this. It's only supposed to find overstatements. So this is an understatement. They have 250. They should have had 300 on the books. They're understated it by 50. We throw it out. Okay. Basic precision. We take the sampling interval. That thing. 5,000. And we go to the reliability factor at 0. Did I put it down here again? Yeah, I did. Okay, reliability factor 0. I forgot what percentage we're looking for. 10%. And the reason we're using the row 0 is that the basic precision is for, look how much space I gave us for this. Okay, the basic precision is if there aren't any errors that you find, if you don't find any misstatements, it's still possible this could be off. It's a sample. So that's what this basic precision is. It says, okay, even if you don't find anything wrong, again, we're taking a sample, so it could be off by a certain amount. That's why we use the 0 row. 0 row is because basic precision is at row 0, what could this be off by? And that's why we use row 0 for the basic precision. It's assuming that there aren't any misstatements. It's kind of like the one we just did. 11,500. 11,550. And again, so if we didn't find any misstatements, it's, doing this test, it could be off by 11,550. Incremental allowance. Now, we only need one of these. So we'll just do the first one. We don't need the other ones. If there's an incremental allowance, you only need to do whatever ones you need up here. So we only need one of them. These other two are not included in it. So only this 4,000 is going to be included in the incremental allowance. Oops. Okay, or statement one. Reliability factor increments times the misstatement largest first. Okay, so we got to find this. So this is the incremental first. So we go down here. Okay. At one misstatement, it's 389. At zero, it's 231. So 389, 231. So this will get that first factor, basically. It's 389 minus 231. Minus 1, 0.58. And so this is what you'll take. So this is reliability factor increments. We're going to multiply that by the misstatements largest first. That shouldn't be a problem. We only have one, 4,000. Times 0.58. $23.20. Yeah. So what we're saying, and basically what this means is the size of the misstatement matters. If it's a large misstatement, that means that the misstatements could be larger. Okay, and all three of those together will be our upper limit. What is it? 50 plus 50, 200. $19,070. Hopefully that's what you guys got. How big was this? Okay, so the book value is 400,000. So that would be a judgment call as to whether that would be material or not. You know, this is You know, is 19,070, is that material? That's a judgment call. 400,000 off by 19, was that like 5% or a little less than that? Any questions? Okay, well, if there are no questions, or maybe you guys are sleeping, don't blame me a bit. I'll send out the practice, no, actual exam, sorry. Okay, so after class here, I will send out sampling exam, and it will be due on Friday, the 17th. You got about 10 days to do it. And I should have that out within a half hour or so. Okay, questions?
Question on what's due on this Friday? That's due.
The chapter, well, I'll also list the chapter, if I don't have it already, I'll have to look and see what I have up there. Well, you can actually turn in the chapter 6 handout. We just finished that. But truthfully, I'll make that due on the same date. But if you get both those, that'll be plenty to work on. So this have you turn in the chapter 6 handout, and then the new thing we got to work on is the sampling exam. Questions? Oh, I just did something on my screen that got all large. Okay. All right. Well, that's it. I'll send out that exam, and if there's something, I don't think there's anything else. There's nothing else that we did, I don't think. So I'll send out the exam, and it'll be due in 10 days. And actually, the handout will be due in 10 days also. I try to give a 10-day kind of, you guys are busy doing stuff, so I know that say, okay, you got 3 days to do it. You go, oh, great, I'm doing all the stuff at work. We got to do this too. But anyway, so I'll send that out, the exam out tonight, and the chapter 6 should be able to be submitted, and I'll check to make sure that that's available after class. Okay, any questions? 2 minutes over. Oh. All right. Well, I know why, because I started 2 minutes late. That's why. See? Oh, now it's 3 minutes. All right. Good night, everybody, and I'll see you in a week's time.
Good night.
Thank you.
Good night.